I want to record this for everybody, okay? So we put this out here. So it's a 5-minute E-mini S&P chart. And it's a very interesting chart. And remember, when we're trading 5-minute charts or small time frames, you have to be very, very reactionary to the prices, right? Okay, so let's begin. All right, so we have a market that's going down, and the first sign we have of a market right here is a situation where the market has buying. The volume is light, so we know that's not demand volume, that's just short covering. So the market continues on trend. Right? Trend will change on a sign of strength. Obviously, not a sign of strength. Comes back down, grinds lower, like reverse absorption to the downside, right? I want to draw my lows. Boom. Any one of these bars could have been the reaction, but it was this bar, right? A little increase in volume, transfer risk. Market goes up. What do we know? The market has a secondary test. What happens? Secondary test, increasing volume, a small little nudge to the downside, Wyckoff's favorites type of spring. So you're going from oversold market that's a shopping action here. Now this is a counter trend. This is more advanced. Okay, it's a little bit more risk in a sense, but it's acceptable Wyckoff wise. Well, Gary, you don't buy springs in downtrends. You don't drive them for positions, but you can do that as a scalp if you have conditions that are met, right? Market's up, nice reaction. Comes back down. The market does not react bullish, does it? Kind of hovering here. So what do we need? Ultimately, we need some demand, right? Remember? Demand. Going down, no supply. Stopping action, a little buying action. So at best, you could say the market's going sideways for a move, and if we get demand, it's the upside. If we don't, it could be the downside. But I'm not as bearish because of the behavior we just described. Buying, oversold. The key bar to this trade is right here. These two bars. This bar here runs away. This bar here. This bar increases volume in range on the right-hand side of this trading range. It's bullish, right? Bullish, right? Here, short cover demand. What's this bar here? Sign of strength, right? Could be wider, sign of strength. It could be wider, so there was something here. Look at the retest. Buying tails. See it? Volume drives up, there's no supply, market marks up. We're going to draw a line across from here. That was the high. Boom. Look at that. I don't happen to my volume thing. So that's the anatomy of a bottom on a 5-minute E-mini S&P. You see the oversold condition. Can't buy it yet, no cause. You have a low. Can't buy it yet. Too early part of the left-hand cycle. Too early. Market does not run away from support. It's actually short cover rally. And the market gets in the area of the buy area to move up. What was your risk if you bought anything down here? Very little. You didn't know that at the time. Very little. That's understanding the story, understanding the tape. It's a must see, must see and observe and trade because shorting the thrust to me is the most important aspect of Wyckoff, right? The reading of the tape, the Wyckoff, and shorting the downward thrust is part of reading the tape. Okay. Very, very important. So you went from a market of weakness to stopping action, short covering, and then some more buying, and then eventually the sign of strength that changed the trend to the top. Makes sense? That's the anatomy of bottom. Now, people say, well, Gary, Wyckoff schematic should be a selling climax. And I've told you endless times The Wyckoff schematic is a paradigm to watch, but not necessarily fall in love with it. Understanding the tape is job number one. If you read the tape, understand the tape, your lines become easier. Okay? That's all I have for now.